Yikes! In congressional testimony, Fed boss Jerome Powell confirms what we already knew. Central bankers, like most economists, are clueless about inflation. Hello, I'm Steve Forbes, and this is What's Ahead, where you get the insights you need to better navigate these turbulent times. Federal Reserve Chairman Jerome Powell sent financial markets reeling when he told a Senate hearing Tuesday that our central bank is ready to jack up interest rates higher and at a faster pace than previously thought. The trouble is, Powell said, is that the economy is not depressed enough. Quote, the latest economic data came in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated, end quote. So the economy is doing better than anticipated and must be crushed. Thus we get the weird situation where stocks bounce up if the economy weakens because investors think this will persuade the Fed to ease off, and equities take a hit when the economy looks better because the Fed will smack it. Although they would deny it, the Fed and other central banks worship at the altar of the Phillips Curve, which posits there is a correlation between inflation and unemployment. Want less inflation? Got to have more unemployment. And the way you get that is by slowing the economy. Want more employment? You have to suffer higher prices. Real-world experience demonstrates that the Phillips Curve is nonsense. For instance, from the early 1980s to the late 1990s, the U.S. and most of the developed world enjoyed expanding economies and low inflation. That changed in the early 2000s because the U.S. decided to gradually weaken the dollar, mistakenly believing this would goose up exports and stimulate the economy. This blunder set the stage for the economic crisis of 2008-2009. Now here we get to the profound misconception of Powell and most economists. Prosperity doesn't cause inflation. What these people can't grasp is that the very definition of inflation is lowering the value of a currency, usually by creating too much of it. They confuse monetary inflation with price increases caused by disruptions to the economy, such as natural disasters, or in our own time by the massive pandemic lockdowns followed by an avalanche of regulations. Powell and company should take a look at what happened to the cost of living after World War II, when wartime price controls and rationing were lifted and people clamored for consumer goods after the deprivations of the war years. You don't convert from making tanks to making refrigerators overnight. Prices zoomed. Things eventually settled down without the Fed trying to manufacture a recession. By not understanding monetary and non-monetary inflation, the Federal Reserve is setting itself up to be scapegoated by the Biden administration when the economy weakens as the 2024 election approaches. The Fed will then likely reverse course and weaken the dollar and set us up for more serious trouble. I'm Steve Forbes. Thanks for listening. Do send in your comments and suggestions. I look forward to being with you soon again.